Hey gang, Dennis Tubbergen here with another economic update. Today is Tuesday, May the 8th, 2018. Today I want to share with you a really great article that I found on Advisor Perspectives written by Jill Mislinski. And Jill offers some really great data as far as employment is concerned and really uses not the unemployment rate. The most recent headline unemployment rate is 3.9%. Which sounds great on the surface, but the main reason the unemployment rate declined as of the last reporting was that a lot of people dropped out of the labor force. In other words, they just quit looking for a job. And when they quit looking for a job, they're no longer counted as part of the workforce, so the denominator of the fraction changes even if the numerator, the number of people working, does not. So it makes the unemployment rate look better. We like to use a labor force participation rate, and as Jill points out in the article, to calculate that that economic piece of data, you take the civilian labor force and divide it by the civilian non-institutional population. Now, if you take a look at this first chart, it shows a labor force participation rate since 1948. And the solid line at the top of the chart represents, the blue line represents men aged 25 to 64. The red line represents women aged 25 to 64. And it's non-seasonally adjusted. But what's very striking is the labor force participation rate for men aged 25 to 64 peaked way back in the mid-1950s. That number did not peak for women, if you take a look, until the 1990s. Now, since that time frame, the labor force participation rate for both men and women have really declined in the 25 to 64 range, but if you look at those 65 plus, that number has grown significantly. Now, it's pretty easy to explain why the labor force participation rate for women peaked that much later than that of men. When you look at those aged 25 to 64, we had the rise of the two-income household for a long, long time. But most recently, if I go down here to the bottom of this chart, when you take a look at those age 65 plus, take a look at the growth or the increase in the labor force participation rate since calendar year 2000. For men, the labor force participation rate for those 65 plus has increased by 40%. Women age 65 plus, it's increased by 74%. Now, why is it? Why is it that those age 25 to 64, we've seen the labor force participation rate decline? And why is it that those 65 plus, we've seen it increase? Well, the decline in the labor force participation rate from age 25 to 64 can be probably best explained by this chart. This is a chart of federal loans to students. Look what's happened to student loans, and this chart measures student loans in terms of billions of dollars. In the last 10 years, student loans have increased tenfold. And incidentally, when you take a look at the trajectory of that chart, the trajectory of that chart has to change. When you see a chart that goes almost straight up, or a price pattern that almost goes straight up, we call that a parabolic chart pattern, and it almost always reverses. So what's happened? Well, you've seen a lot of folks ages 25 to 64 stay in school, get more education, and as they're staying in school, they're accumulating debt to do so. When debt accumulates, as we all know, that is a big long-term drag on the economy. So not good news there. Now, if you take a look at the workforce of those age 65 plus, now why is that you've seen such a big increase there? Well, bottom line is this: people cannot afford to retire. There's been a couple big market sell-offs over the last 15 years. The tech stock bubble crashed back in 2000, 2001, 2002. Those were all negative years in the market. When the real estate market collapsed in 2008, it also devastated a lot of nest eggs. So you're seeing older people stay in the workforce longer, namely because they can't afford to retire, and you're seeing younger people stay in school longer to try to improve their employment prospects, and they're doing so while accumulating debt. Those are both long-term not good trends for the economy, and why we're bearish on the economy, and why I would be bearish on stocks and real estate. That's today's economic update. It's Tuesday, May the 8th. I'm Dennis Tubbergen.